All right. Hey, you guys, welcome back to EXP Family Tree. I am not in my normal office location. I'm in a car office today. We have an amazing guest with us today. Some of you have been on these calls when we've had Tommy Thornburg and some others from Prime Corporate Services. And they are an amazing company. I'm going to go ahead and put a link after you speak or after you hear John speak and you have some conversations. If you want a free meeting with them, they've been so kind as to give me that opportunity for anybody here in EXP Family Tree. So I'll post that in the chat if you guys want to grab it. But today we're going to be talking about tax prep, tax strategies, and how to keep more of your own money. And there's probably more to that. And John's going to share what he's going to really talk about. But Prime Corporate Services works with a tremendous amount of realtors and investors across the country and a lot of different things, from entity structure to taxes to, different business credit lines. And there's a whole bunch of other things. And again, John will probably be able to elaborate, but I've referred a tremendous amount of people to them to help them really get their businesses in order. And, oftentimes as entrepreneurs, because we're driven people, we're always thinking about how do we go make more money, make more money, make more money. And yes, we want to make more money. And if we can keep more of our money that we do make, that is a really good thing. And oftentimes that's not where we naturally go to in our strategies or our mindset. And that's why we do need to have these conversations around taxes, whether we like it or not. So I'm very happy that those of you that are joining live decided to make this part of your day. And the many of you that are watching live stream, thanks for doing that. If you have questions, you can raise your hand or chat in the chat box. We want this to be interactional. If you're watching live in the live stream, you can chat below the live stream in the workplace group and I'll monitor it and let John know if there's questions that come up. And so without further ado, John, I'm going to let you just take it away, give a little bit more about yourself. You can share screen if you want. You do have that access, whatever is going to work best for you. But we're really, really glad to have you. Thanks for being here.
Thanks, Cari.
Yeah.
Okay, guys. I am an accountant, but I will try my best to not sound like an accountant. We have a firm here. We're south of Salt Lake City in Utah. We have about 100 team members now. And as Cari mentioned, we work. So my firm's name is Insight Tax, and Prime is a partner. They're one of the owners in our firm. And so we do the fulfillment for the tax services. One of the things we're going to talk about tax, right? The sexiest, most exciting topic that everyone wants to hear about. Because of that, I find it super important that as you have questions, please ask them. I am totally fine to be interrupted in my presentation just because you might need a break from just the constant deluge of information I'm going to give you. And questions also help others who might have the same questions or don't realize they had those questions kind of formulate how what I'm talking about will apply to them as well. Yeah. I get it. I literally have a master's degree in tax. I love this stuff. And I know most people don't. What you do love, which we'll get to, is the stuff you can do when you save on taxes. That's really where the fun stuff begins. So quick legal disclaimer, even though I am a CPA, I don't know your specific situation. Let me just give you a story that happens. So imagine as a third-party observer, you are witnessing, my wife asks me, as I'm sitting on the couch watching a football game, "Hey, honey, will you take out the trash?" And I said, "You bet." And then, so just that simple interaction. What happened in my mind and her mind are two different things, though. What she thought she asked was, "Will you get up immediately and empty the trash right now?" The reason I know that that's what she was asking is because after I didn't get up after 10 seconds, she very aggressively emptied the trash can and walked out, giving me that look, she walks by like, "You said you would, but you didn't." Because the way I responded was, "You bet." But what I thought what I was saying was, as soon as there's a timeout and a commercial break, I'm going to get up and empty the trash. So that's why we have legal disclaimers. Sometimes we hear things a little bit differently.
Yes.
Okay. IRS sucks. We're going to make them not suck for you. That's what we're here for. I think of organizations, the IRS, and not necessarily by the intention of the employee itself, but they're just set up to be the biggest bullies that exist in the US. I get a lot of pleasure out of helping people not be bullied by them. And my team subsequently also likes that as well. So 100 years ago, there was a court ruling. And I want to briefly talk about this because it's relevant to us even today. So to get into Washington, D.C., there's the Potomac River. And there's a toll bridge that you can take to cross the river. And so this judge in a ruling, so this is part of law, in a court ruling gave this explanation. And he says, look, if I went over the toll bridge and I didn't pay, that's tax evasion. We do not recommend tax evasion. It's illegal. It's bad. Don't do it. Right. But if I use a toll bridge and don't pay, that's tax evasion. However, I could drive a little bit out of the way and use a free bridge. If I did that, which is very legitimate, that's tax avoidance. So here's what the part I want to emphasize of his ruling. For my tax evasion, I should be punished. For my tax avoidance, I should be commended, as in celebrated, rewarded. The tragedy of today, okay, this was 100 years ago, when the tax code was 2,000 pages, not 78,000 pages. The tragedy of today is that so few people know the free bridge even exists. So what we're going to talk about today in this presentation are some of the free bridges that are available to you so that you can do legal, legitimate tax avoidance, which should be celebrated.
Wow.
We're going to start with the lowest hanging fruit. And Cari already mentioned this. Prime is really good at setting up the right entities. And I'm going to tell you why it matters. So in the world of all business, and then we'll narrow it down to real estate. But in the world of all business, you have C Corps, you can have an S Corp, there's partnerships, there's LLCs, there's sole proprietors, you have doing business as DBAs, as they're called. There's trust, estates. All of those are kind of referred to as entities, the legal term to name some sort of business structure. Most people set up LLCs these days, which is great because they're really easy to set up. The issue, though, is that these were created back in the 70s. The first LLCs were created in Wyoming. And apparently 50 years isn't enough time for the IRS to write specific new rules on the LLC. So the tax code actually says we're not recognizing LLCs per se. Based on how they're set up, they're going to be taxed like something that already exists to us. So if I set up an LLC and I'm the 100% owner of it, my default tax status is a sole proprietor. I'm going to talk about that in a second and what that actually means. If I add more than one owner, so if it's me and at least one other person, those are called multi-member LLCs because there's more than one member. Default tax status for multi-member LLCs is to be taxed as a partnership. Or I can elect to have my LLC. So I have to go a little bit out of my way, not a default status, but I can go a little bit out of my way and file a paper with the IRS that says I want to be taxed like an S Corp or I want to be taxed like a C corporation. Why does this matter? Because a lot of people don't realize, hey, I heard I need to set up an S Corp. You can't set up an S Corp directly with the state. You have to set up something else and then tell the IRS I want it to be an S Corp because S Corp literally is a tax status. It's not an entity status, right? Pretty crystal clear, mixed with mud. So, which is typical with the government. So now let's talk about why this matters. As a sole proprietor, the IRS is going to tax me self-employment tax, currently 15.3%. Self-employment tax is another way to say payroll tax because you're the employer and the employee. Sometimes people call it FICA, FUTA, SUTA. Those are all acronyms. All of it really refers to this 15.3% payroll tax. That's self-employment tax. You still pay income tax on top of it. That's why sole proprietor is the worst tax structure you can possibly have. It's also the worst liability protection you can have because it doesn't give you any liability protection. So some people say, well, I want liability protection. Okay, so they set up the LLC, but they're 100% owner. So they get some liability protection, but still tax-wise, they're paying that 15.3% on top of their income tax. So it's not uncommon for someone who has taxable income of 30 grand to be paying 35% tax rate if they have a bad tax structure. We want to avoid that, obviously. If I have a multi-member LLC, the LLC is going to issue me a K-1. So just like an employee gets a W-2, contractors get 1099s, owners get K-1s. So this K-1 gets reported on your personal tax return, and guess what? It also is subject to 15.3% self-employment tax in most cases. Okay, so kind of a couple situations we'd like to avoid. S corps, on the other hand, when I get my K-1 from an S corp, that income not subject to that self-employment tax. Well, then why doesn't everyone do an S corp? Not everyone does an S corp, especially in real estate, because there's passive activity and there's active activity. So why does it matter? Passive activity, the IRS classifies in a way so that there isn't self-employment tax tied to it. It's not considered self-employment income, but active income is considered self-employment income. So you can see on the screen the different types of real estate related activities you can do. The blue side on the left is passive activity. So all of these types of activities could result in taxes not subject to self-employment tax, which means I can have an LLC. I can have a multi-member LLC, tax as a partnership. That won't hurt me because I don't have the 15.3% tied to those types of activities. The active activity, which is considered ordinary income, is self-employment income. And so these are the ones that we want to run through an S corporation structure. So you can see them there. I'm not going to read the entire list for you. Let me just point out, usually if you look at the list, you're like, wait, the whole buy, rehab, rent, refinance, that strategy, it's on both sides. How does that work? Well, it kind of depends on how you handle that property, right? If I'm holding it, so I refinance and I'm just holding it, that's a passive activity. But sometimes, if I'm doing a lot of these, the IRS comes in and says, if you do more than 2 a year, we actually consider the fact that you bought a property and improved it inventory. So they could come in and almost say, hey, this is inventory related, therefore that's ordinary income, therefore you need to pay us something. So a common structure we've used with our clients who do this strategy, it also gives them some flexibility, is you actually buy the property inside of the S corp, do all the rehab stuff inside the S corp, then the S corp sells the property over to an LLC that you own. We can do it in a way so that you don't have any capital gains, so you don't have any tax on it by moving it. And now if you're going to hold it, it lives in an LLC. So that way, if the IRS came in and looked, there would be no confusion or no possibility that they could come in and try to claw back some self-employment tax in that scenario. When I first learned about this and figured out the structure, the client I was working with, he liked it because he actually sometimes decided he just wanted to, even though his intention was maybe to rent it out, he's like, you know what, I can make pretty good money on it right now and I have a buyer. So he would sell it. Because he started with the S corp on the S corp side, it became a fix and flip, which is what we want to run through S corps. And on others, he said, no, this rental income is going to be great on this property. I want to hold it. And so we can move it over. So there are some examples, but ultimately for your situation, identify where your rental activity falls. Do you need an LLC or do you need an S Corp? And as Cari mentioned, Prime, there'll be a link at the end. You can have a free consultation with them. You can tell them what you have going on, and they'll help you identify what the right entity is for you to set up and even do it for you. I've been doing this for a long time, and I think it's like, so it's the least expensive entity setup that I've ever seen in my life, which is why I love them so much. Let me just pause there. Cari, are there any questions coming up yet?
I don't see any, but does anybody have any? Do they want to just unmute themselves if they do? Or any thoughts yet? Feel free to unmute if you want to. I'm not seeing anything. We have a lot of people watching live, but no comments on the live stream yet.
Great. Okay, so next thing we want to talk about, because we just always get this question, what is this real estate professional status and how do I get it? So I'm going to tell you, these are the rules, the tax rules on how you can qualify for the real estate professional status. But I will say this, and I'll explain why it's good, but just know if you don't qualify for the tax definition of real estate professional status, it's not the end of the world. With proper entity structuring, you can get a lot of the same benefits, not all of them, but a lot of the same benefits with entity structuring, even though you may not qualify. Because obviously, if you're in the real estate world, most of you probably consider yourself a real estate professional. Taxes have their own fun little definition. So if you can get this, you get to claim all your losses. Well, hold on. I thought I could claim all my losses anyways. No, this is how the IRS works. So if I have a passive activity and it generates a loss, the IRS will limit that loss to the extent I have passive income. Now, if I have ordinary income, so on my S Corp side, if I go back to this slide, on this S Corp side, any losses generated on the S Corp side, I can claim all those. It's the losses generated on the passive side that the IRS has pretty strict rules about. So it's like S Corp, I can claim all my losses, that's good. LLC side, I can't claim all my losses, that might be bad. Again, it would take a very specific consultation to figure out, if you don't qualify for real estate professional status, how your entities need to be set up. But we can get around some of these detriments. The one thing for sure we can't get around, if you do qualify for rep status, you do avoid net investment income tax on all your gains. So if you are selling properties, it's a 3% tax savings, basically. This was created from Obamacare, still lives on to the code today, but proper entity structuring will not get you around that, but it can get you around finding a way to claim a little bit more of your losses. But if you qualify for this, this is obviously the easiest way to get those benefits. So how do you qualify? More than 50% of your services need to be in real estate. You can see on the right-hand side, the different activities. These words are specifically from the tax code. This is what the tax code refers to it. So obviously they're decently inclusive. But that means if I work 1,000 hours during the year, at least 500 of them need to be real estate services. Oh, okay. Well, if I work 3 hours a year doing real estate stuff, only an hour and a half of it has to be real estate. And there we go. Well, the IRS said, hold on, there's got to be some bare minimum level. We got to make it harder for these people. So they added the next rule, which is perform more than 750 hours of service in real estate. And then the last one, I'll just briefly cover: materially participate in each rental activity. Honestly, if you qualify and hit the first two, 50% and 750 hours, we've never had an issue with someone being able to show they materially participated. So sometimes this comes up because it's like, hey, I have a full-time job and I do some real estate stuff on the side because I'm trying to get this hustle where I can maybe replace my job. But in the meantime, I do have a W-2 job. So if you have a W-2 job, unless it's part-time and you can prove it's part-time, the IRS will assume at least 2,000 hours were worked on the W-2 job, which means you would need at least 2,000 hours documented in real estate activities to qualify for tax rep status. So in those scenarios, sometimes there's a spouse involved and the spouse doesn't have a W-2 job. In those cases, we want the spouse to be the one who's on record as being the real estate professional doing the activities. That way, we just have to get to the 750 hours instead of 2,000 for a W-2 job. Hopefully that makes sense. And on the activities, you can see them there. Again, I'm not going to read the list, but I do want to highlight, because I spent a lot of research trying to find a way. I'm like, please don't make this true. But sitting for educational things is specifically listed as not counting as a real estate activity. So there's no way around it. I just wanted to throw that out there because sometimes people are like, well, I spend, 10 hours a week in classes of some sort, real estate related. That doesn't work. They want it to be actual real estate activities. Okay, so that's rep status. Now let's get into saving taxes, actual taxes. The IRS code says in order for something to be written off, it has to be ordinary and necessary. Because we get this question a lot. Hey, what's a write-off? How do I claim it? Is a write-off an expense? Is a write-off a business deduction? Yes, all of those relate to the same thing. But if I just tell you that the definition that the tax code uses of ordinary and necessary, how clear do you feel you are on what I can write off in my business or not, with my real estate activity or not? Is there really ordinary and necessary? Come on, like, okay, they all feel ordinary and necessary. And I can tell you what you and I think is ordinary and necessary, the IRS does not agree with. So a group of accountants had gotten together back in the day and they said, look, this just isn't clear enough. Can you clarify what you mean? Because we're getting a lot of questions and, we'd rather avoid having to deal with audits. Okay. So they put a crack squad group of people together, their toppest talent, the smartest, brightest people the IRS had to offer. And they said, okay, we got it. We'll clarify it. Helpful and appropriate. How's that for clarity? Yeah, also two completely generic words that don't really help us at all understand what is a write-off. So now we got 4 words: ordinary, necessary, helpful, appropriate. And I can tell you from personal experience, again, what they're interpreting under those 4 words is very different than what we interpret. So here is the best way to figure out, can I write this off in my business? You just have to ask yourself this simple question. If I'm spending $1, does this relate to my business in any way, shape, form, or fashion whatsoever? Can I relate it to my business? If I can, then that means in my mind, I have a good reason why it's ordinary and necessary and helpful and appropriate. Worst case scenario, you get audited. They ask you for your proof. You give them proof and they say, yeah, this still doesn't qualify. It's one of the many exceptions. If I at least had a reason how I thought it was connected to my business, then they just say, okay, yeah, well, you didn't understand the tax code, so we're going to make you pay tax on it right now. Okay, not the end of the world. If I don't have a good reason for it, now all of a sudden they can say, maybe this person's trying to commit fraud. They open up audits for the last 6 years. It gets a lot hairier, a lot messier. That's why, as long as you have a reason why you could legitimately explain why you feel like it's related to your business, if you end up being wrong, worst case scenario is if they ever do audit you on that specific expense, you have a reason to it and they just make you pay tax at that point. So it's painless, if you will. You can see on the slide there some of the examples, common examples of types of business deductions: advertising, see, marketing. I feel like with real estate activities, there's a lot that can probably go under marketing that you spend that's designed to help you generate new clients, more clients, return clients. We're going to talk about some of these specifically, but let me also now pause just to see if there's been any more comments or if there's any current questions with people that I can see here on Zoom.
So anybody have specific things that they're wondering about that they want to write off or have heard of but never tried it? This might be a good spot to ask that question too, what John thinks about it.
I have a question about gifts.
Yes, please.
So from what I understand, the IRS limit of gifts is pretty ridiculous, like that you can't find anything at 7-Eleven for that price. So how do you suggest we still give gifts and thank our clients and do the right thing on stuff, but not have to eat that cost? Are there still ways around that as far as the limits, or just take the limit and the rest is a loss?
Yeah, so the limit is like $25 per person per year or something.
Yeah.
With inflation, our big gulps probably big gulps cost more than 25 bucks. No, but yeah, the gift limit is ridiculous. How about though, instead of giving a gift to somebody, you have a process where you market. So I have a marketing expense now. When I close with a client, I put together a marketing basket that also includes other people. Maybe I'm including a coupon for a pizza place, for example. I know that when we moved into our homes that first night, man, it was really cool. One of the realtors like gave us a coupon to get a free pizza because we didn't have anything to cook. So now I'm including other businesses. Now I have a marketing basket that I'm giving as part of a marketing effort. Marketing has no limit. So it's almost as simple as putting it under that, guys, that so it's not considered a gift.
And correct me if I'm wrong, if we have stuff like embroidered or coffee cups and it's our stuff, then that definitely includes marketing or advertising because it's how our business stays in their home longer, correct?
Absolutely. Yeah. On physical things, you don't necessarily need a logo on physical things. You could still market it, but obviously having the logo gives you the better story if the IRS asks, like, well, I want to stay in front of them because most people don't buy a house every year, but when they buy their next house or sell this one, I want to be top of mind. That's a great reason why you claimed it as a deduction. When it comes to close, if you're giving the close away, obviously if your logo's on it, that counts. We do get this question though, as far as like, what can I write off? Technically, if your logo is on any article of clothing, that technically can be written off as a business expense, regardless of where that logo might be placed. You would just, if you're audited and the IRS said, hey, I want proof, you would need to show them the article of clothing. I'll let you guys determine how aggressive you want to be. Some have been known to write off some of their professional attire when they show homes as advertising, because their argument would be, I only wear these clothes when I'm showing houses. Therefore, it's specifically business related. Because, for example, there are industries that hire models, for example, and when those models are hired and they do a photo shoot, usually attire is provided. There's like giant things of clothes on hangers. Of course, those are business write-offs. You're just doing it at a little bit smaller scale. So maybe I'm buying clothes specifically to do recordings, because nowadays, right, YouTube showing homes, that's one of the common ways to market these days. Or I'm just using it specifically to show homes. So that's the way I would think about some of those things when it comes to marketing.
So John, I've had, in relation to that, I've had some people share with me, you know, for an example, I do a lot of speaking events. I do both in person and online. I do a ton of video. Most of my business comes from those venues. And I have been told, and I don't know if this is correct, I haven't done this yet because I'm always a little bit nervous about it, but like, just, yes, my attire, because I have to be presentable to do that. And some of my attire is actually pretty specific. Like I will buy clothing that has certain verbiage on it because it's just kind of part of my brand, so to
Yep.
speak. It's not
Mhm.
a brand, it's part of my brand though, like it's my clothing that I purchase and that I wear in my videos. But even just as much as like, you know, your hairstylist and things of that nature. I mean, how far-fetched is that and or not, depending upon how active you are out there and can prove that, just out of curiosity.
Yeah, not far-fetched. Like, I don't know if you guys can, those who used to have the video, I have an Insight Tax branded t-shirt that I wear every single day. One of the reasons is so that I can write off all my apparel. I also record a lot as well. And so the argument could be made, right? Like I bought these because I have a photo shoot. I bought these because there's a video I want to record. And if the IRS asked, you could put together all these clothes and put them on a hanger and say like, yeah, this is the closet that I use when I record videos because I bought them just to record videos.
Yeah.
On the hairstyling and like nails and things like that, even if like makeup,
Yeah.
whatever those types of services are related, you do have to be a little bit more careful. You'd want to pair that with being able to document, this is the exact video I shot the same day, meaning I got my hair done to do this video.
Yeah.
Right. I got my nails done to do this video, and here's evidence of the video that I recorded. You'd be fine that way. Because again, same with models, which is an industry which makes these expenses ordinary, necessary, helpful, and appropriate. They have all those hairstylist people. Look, celebrities by default usually are really attractive anyways, but it sure helps when they have a professional team behind them who does their makeup, who does their hair, that matches it with, right, all that stuff. We're doing the exact same thing. It's literally no different.
Yeah. Yeah. Thank you. And of course, if you're doing all your video equipment, all the things that we all buy now to do that, like all of those things, if it's a regular part of your business, we need to be thinking about all of those things, right?
Absolutely. Yep.
There was another question, and I can't read as much because I'm en route, but I believe is it Eddie's iPhone?
Yeah, I can see his on Zoom here. So P, LLC, and LLC both have options to be filed as an S Corp. Yes, Eddie, that's correct. Any entity can be elected to be taxed as an S Corp, even a C Corp. You can create a C Corp and then elect it. So yeah, PLCs. If you want to know the technical detail, I'll just let you know, it's Form 2553. You fill out the first 2 pages, you send those off to the IRS. That's how you tell the IRS, I would like you to treat me like an S Corp. Then you wait 1 billion years for them to send you back a letter saying, cool, we accept you as an S Corp. Just because they're really slow at processing things because it's the IRS.
Great, thank you.
Yep.
Awesome.
Okay.
Other questions? Any other examples that you just want to run by, John, quickly? Anybody got something burning up top of their mind?
Slow until you owe them.
What's that mean? Tell us. Slow till you owe them, Jennifer.
That they process everything slow until you owe them money.
Oh,
Then they're
yeah.
like,
Oh,
okay,
Done
so
their
that's
fast.
due tomorrow. Wait, what?
Yeah,
Yeah, true story.
it's very true. Yeah. Kind of like mortgage companies, right?
Mhm.
Like they ignore you until they need more stuff. And then it's like, hounding.
Now it's urgent. Now hair's on fire. Yeah.
Okay, cool. As more questions come up, feel free to ask them. I wanted to share an example with you of buy and hold versus flipping, just so you can kind of see the some of the intricacies. So if I buy and hold, the type of income I make is rental income. I claim it when I get it. Most people are cash basis. They call it cash basis, meaning I'm only worrying about when I receive cash or I pay out cash. That's how individuals are taxed. On buy and hold, if I buy something and put it in the property, it's greater than $2,500. The IRS says I need to claim that as an asset. Assets go on the balance sheet. They're not specifically tax deductions, although they turn into tax deductions. And if people have questions about depreciation, we can get into it, but that is a whole rabbit hole that I could go pretty technical on. So just know that I can claim it as an asset. Currently, there's rules in place that make it so that I can get a tax benefit from that asset anyways in the first year, but it's not always straightforward. If I put something into the property and it's less than $2,500, it's just a straight up expense. Again, all of that happens when I spend the money. I can take some depreciation. So the purchase price of the property, I can depreciate that. Or we have a great relationship with a cost segregation company. That's where you take the full purchase price of the property and segregate it into different depreciation buckets so that you can take more expense faster. Again, I can answer questions about that, but we can get pretty technical as well. And I will say about cost segregation, other than knowing how it benefits you, you don't actually need to understand what is happening on the filing and the engineers and all that stuff. Because it's technical on that side, but we can understand the benefit. Any interest I pay on holding the property becomes an expense, property tax, obviously, and these are considered passive income. On the flipping side, when I sell a property, it's considered sales proceeds, not rental income. And I am going to claim that income when I sell it. Now, here's the big difference with flipping and buying and hold. Basically, everything I spend on the property until it's sold is considered inventory. It will eventually become my cost of goods sold. So I buy a property for, I mean, maybe there's some areas this still works, but just for simple math, I buy a property for 100 grand. I put $75,000 into it. I don't get to take that $75,000 as an expense until I actually sell the property. In that case, maybe I sell it for 200 grand. Then I would take the 100 I paid for it initially, the 75 I put into it. All those would be considered cost of goods sold. I don't take any depreciation. I would just pay tax on that $25,000 difference. And this would be considered active income. So just an example to kind of show you the difference between one of these different types of real estate activities. All right, travel expense. I love this one for real estate professionals because it's the lowest hanging fruit, and your profession by nature gives you what we call business purpose. And that'll make more sense in a second when I explain the rules of how to write off travel. So first thing, in order to claim an expense for it to be travel, I have to travel away from my tax home. Often our primary residence is considered our tax home. So theoretically, if I had a camp out at my neighbor's house and we slept in a tent in their backyard, that is technically a travel day based on tax rules. Anytime you don't sleep in your bed at your house, it can be a travel day. Now, the trip needs to be mostly for business, and that's measured by days. Mostly is more than 50%. So if I took a 5 business day or a trip that took 5 days, I would only need 3 of those to have business purpose in order to write off all 5 days of activity and expenses. Fun fact about this, if Friday is considered a business day and Monday is a business day, Saturday and Sunday are automatically counted. Also, the day that I'm traveling, that day is also considered a business day. So hopefully you can see it's a pretty easy to get mostly business days done or calculated or classified for your trip. This is the big one though, business purpose. There has to be business purpose. There's no rule that says how long business needs to happen during the day. There just has to be a purpose to it. And it's got to be proven that you had the business purpose before you went on the trip. Like I can't go to Belize and then strike up a conversation while I'm hanging out on the beach and say, "Who, cool business purpose." The IRS would have said I had to have known that person ahead of time and scheduled with them to have that meeting on the beach. So one of the easiest ways I have found to document this, especially for realtors, anywhere you go, there's land, there's possible real estate activity. And last I checked, everywhere we can go has land. I won't get in, I don't know, space flight and how much that costs. And if a planet in space, I don't know, these guys that are trying to explore the space, good for them. Business purpose though. So I can email a realtor in the area I'm going to and say, "Hey, I'm coming into the area. I'd love to get together to talk about trends you see in your current location." Or, "I'm coming into the area. I was wondering if you could show me 2 or 3 properties that fit this criteria." I have the email, I send it. By sending it, I now have a timestamp. I have documented business purpose, and that's all I need to save. I don't need to save the response. Maybe the person ignores me. Doesn't matter. That proves that I have business purpose in going to whatever area. And so with that in mind, that's how you write off travel. And again, as a realtor, you guys kind of have the golden egg here, if you will. Almost every travel you do could likely be written off. So let me pause there for a second, see if there's any other questions about travel or if something else came up on some other issue.
I don't have anybody else. I'm not seeing any in the
Okay.
chat. Let me look in the live stream. I just had somebody else join. They might have a question. Nope, just people watching and tagging each other. Nothing, no questions in there either.
Okay. Here's the next one. I 2 of my favorite things. That's why we share them on these presentations. Some of the lowest hanging fruits and some of the biggest bang for your bucks, right? We started this telling you, I wanted to share with you some of the free bridges that existed. Travel's one of those free bridges. Tax avoidance is good. It should be commended. We should all celebrate each other. This is another one. It's we call it corporate rent because that's the practical application of it. The world, a lot of people refer to it as the Augusta rule. So if you Google the Augusta rule, you're going to find so many articles on this. At insidetax.com, I've probably written 5 or 6 blog posts on this. So if you ever want to call back to this idea or rewatch the recording. So it's called the Augusta rule because every year, Augusta, Georgia, these guys get together and they play this really crazy game and they're obsessed over winning a green jacket. So it's the PGA, it's the Masters tournament. And I don't know why it's green. Man, maybe it's related to the putt. I'm sure there's history there. But yeah, they're obsessed over this thing. Well, Augusta, Georgia is not actually that large of a city. And there's not a ton of hotels, but it's also a very wealthy area. And if you weren't aware, the tax code is 76,000 plus pages because wealthy people pay lobbyists to get rules put in place to benefit them. And I'm all for that. I love that. This is one of those scenarios. So these wealthy landowners and home with big homes saw this scenario and they said, hold on, these guys are coming to our town every year. They're paying how much to watch these guys play golf? Okay. Yeah. I bet they'd be willing to rent out my house for quite a bit of money. But you know, I don't want to pay tax on it. So what could we do? Let's hire a lobbyist. Let's get a rule in place. Enter the Augusta rule. So the tax rule is if I have a rental property and I rent it for more than 14 days, that defines it as a rental activity. But what is often overlooked is that if I rent a property out for less than 14 days, by rule, it is not a rental activity, which means by rule, because I didn't have a rental activity, I don't have to claim any income on anything up to 14 days. So we just say, large companies rent convention centers or hotels to have company meetings. Let's have small business owners do this themselves. But instead of renting a hotel, let's just rent their living space. So your business entity will contract with you as a person. It's a very simple lease agreement to rent your space 1 day per month. So that's 12 days out of the year, less than 14, which means if I make any income off of this, it is not considered a rental activity by definition. Therefore, I do not have to claim any income for rental income by renting out my house. Okay. And when I pay for this expense out of my business, that is considered an ordinary, necessary, helpful, and appropriate rent expense. So it reduces my taxable income, but I don't have to pick it up on my personal side. That's why the Augusta rule is super cool. So we recommend 12 times a year. Your business takes the rent expense. The transfer from your business account to your personal account is the paper trail that is critical in this scenario. Having the lease agreement is important. Having meeting minutes is also important. But theoretically, you could go back and look at your calendar and make those up if you wanted to. I'm not suggesting that, but it could happen. You can't go back and recreate the paper trail. I personally have represented a client through an audit of this. The IRS agent was not happy and he lost. It was so satisfying. He tried to pull in some other tax rules and I just kept going back to the rule. Nope, here it is. Hey, okay, here's the rule. You go ahead and interpret it for me. Okay, go ahead, get your supervisor to interpret it for me. All right, so we're good. But if my client didn't have the paper trail, he would have been screwed. So we recommend nationwide, the amount per day that you should pay yourself is $1,250. So you do that 12 times, that's the $15,000 you see there on the screen. That's our generic, like, we're pretty confident you could find documentation to support that anywhere in the country. Now, some people live in other areas that are more expensive. So we have some clients in New York City, for example, and they're doing $4,000 a day instead of $1,250. Well, how do you know what the difference is? A couple things you can do if the $1,250 is like, you want more than that. You would go to some sort of vacation rental website, find a house similar in size, close to your geographical area. If their nightly rental cost is more than $1,250, you can do a screenshot save of that. That's your evidence as to the newer amount that you're going to use. Or if there's a hotel nearby, you can go to the hotel and ask for a quote to rent a meeting space. And you just make sure that you request, hey, I need full service catering. I need to rent utensils. I need to rent tables. I need to rent furniture. I need to rent multimedia equipment, projectors, and all that stuff, because your house has all those things. And then that quote, if that's more than $1,250, you could technically use that quote. But those are the ways we like the Augusta rule. So we call it corporate rent because it's literally a rent expense on your corporation for the necessary monthly board meeting you are likely having anyways. So there you go. That is the Augusta rule. We love it. Any questions?
I want to kiss you right now. That's huge. I've heard of it before, but the way that you explained it, that makes a lot of sense. And then a lot of that paper trail really isn't a lot to make sure to put together. That way you can stack it in your files for the year. So I appreciate the clarification there.
Yeah, you're welcome. I'll add too, sometimes people ask like, well, I have like 6 entities. Can I have each of the entities do it? It's based on the number of properties, not entities. So some clients will have a second home that they aren't Airbnb-ing or vacation or whatever, Verbo. They're not short-term rentaling it. So it's a legit second property. You can do it on a second property, but if I'm doing a short-term rental, it's already getting rented out for more than 14 days. So you wouldn't do it on that. So in case anyone had questions about that.
Do you think you could get away with a long-term rental at all if like there was like a patio area that was good for meeting space?
No, because you're already renting it out for a long-term rental, so you're going to be over 14 days already.
Oh, gotcha.
Okay, we're getting close to time, so we won't dig into this too much. But if you have children between the ages of 7 and 17 and a half, there's an option to pay them. The rules are pretty cool. There's a whole tax strategy. You want to set it up the right way. But if you're in this scenario, there's a possible way to like pay them up to 13 grand or almost 14 this year, where you don't pay payroll tax on them. It's a business deduction on your side. But again, there's no way I can cover that in 5 minutes. So I just wanted to put this up there too. And I think Cari sent the link in the beginning.
Yes.
Any of these things I talked about, our agents can talk to you about it. Again, lowest hanging fruit, proper entity setup. Then it becomes, I have some questions about, can I write this off or not? Our team wants to meet with you. We want to save you on taxes. I'm the tax guy, so I don't talk too much about business credit, but man, they do a lot with the business credit. One of their biggest success story, to my knowledge, is the guy started flipping RVs because he wanted the RVs to be short-term rentals, but people were just so interested in how he flipped them. Or no, they're Sprinter vans. They weren't RVs. He wanted to turn Sprinter vans into like short-term rental things, but people just loved how he did it and they bought it. He had enough success there, ended up on Shark Tank, got a deal with a shark, all because he started with a business line of credit and was able to use that line of credit to fund the operations. He didn't have to use any of his own cash to grow this. Pretty cool story, but we're here to serve. And so we'd love to see you on a call.
Absolutely, you guys. My husband and I did the call. I've sent it to many people. They've said it's but one of the more informative calls, free calls that they've gotten. I think it would be well worth the time. I mean, John, you did an amazing job. You have a great way of just making this not be as overwhelming. And there's just some very, very tangible things that I think the mass majority of realtors just don't know.
Might have lost her.
Hey, John, well, we lost her real quick. With the kid write-off, do you have to be an LLC or S Corp?
In order for the strategy to work, it has to flow through an LLC because the tax rule is an unincorporated business. So incorporated would be a C Corp or an S Corp. So unincorporated, owned by parents, you don't have to pay payroll tax. So it does need to run through an LLC.
Okay, all right, thanks.
So with what you just said, is it suggested that you have two entities, an LLC and an S Corp or C Corp?
Yeah, for very few scenarios, I would ever recommend a C Corp. But yeah, for like if you're getting realtor commissions or you're flipping, so there's an S Corp in your structure, most cases we have another LLC set up and it becomes a management company. So the S Corp will pay a management fee to that LLC and then that LLC will employ the children.
Gotcha. So, I was the one that asked the PLLC question. So I'm licensed in 2 different states, Arizona and California, and EXP wouldn't pay me 2 different ways. California, I was an LLC and they were paying my LLC, but then when I got my Arizona license, they said they can't pay Eddie in Arizona and they can't pay the entity that Eddie owns, an LLC in California. So now they just paid me directly the last 2 years, which I didn't like. But now, now I'm planning on restructuring. So I was either going to do a PLLC in California or Arizona. I haven't decided yet. My driver's license is in Arizona, but my primary residence is in California. So I think I was going to lean on the California side for my PLLC.
I would not.
And then
I don't know. If you can stay away from a California entity, I would, because they're going to charge you a minimum $700 or $800 a year. just
Yeah.
for the privilege of being in their state, which means they harass you. I
Mhm.
wouldn't do a California entity, but you know, a prime agent who knows a little bit more about that structure might be able to help out.
Okay. Actually, I had a S corporation, but then it wasn't making that much money anymore. It's turned into a hobby business. So I actually have a nonprofit organization. So
Okay.
right now I'm trying to roll with nonprofit, my PLLC, and then whatever, and then my taxes whenever I file them for the end of the year. So I'll take your advice because I haven't started on the PLLC, but I know I can get that knocked out in a pretty short time. And like I said, Arizona is probably the other option then.
Yeah, I would lean towards Arizona if you had the choice. Just be careful on that nonprofit, depending on the activity you have going on. Like the IRS doesn't have a whole bunch of resources to monitor those, but when they do find it, if they feel like you were doing activity that doesn't support a nonprofit defined like definition in the tax code, that could get you in some issues. So we like nonprofits as part of an overall structure, but I don't know if you said you're running all of your income through it.
No, none of it at all. Actually,
Okay.
it's fully nonprofit and it does community service. It
Oh, great.
has I put not a manufacturing, but like a wholesaling business in there because it's a product that I make it in manufacturing. Like I said, I wasn't making too much money, so I put
Awesome.
it there, and I just utilize that, and I could do like management fees here and there and expenses because it's in the hockey world and that's part of my life. So
Got it.
whenever I do my hockey travels, I use that business to expense some things.
Cool. So let me just make one more comment because I think this will serve all of you who are listening, and then we'll end it. But it's not the end of the world if a brokerage is paying you in your personal name. I don't understand the state rules with it. My personal opinion is I think it's just straight up laziness on most of the brokerages part, even though it's pretty easy to just get a new form and issue payment to someone else, but whatever. There might be legal reasons why they do it. From the IRS's standpoint, there's ways we can file your tax return. It's just important you have a right CPA who understands how to do that. If you have an S Corp and your intention is all this is S Corp income, even though the check was written to your personal name, you would still deposit it into your S Corp. I've never had a client say the bank is not accepting these deposits. So that's not an issue. And then there's a specific thing we have to do on your tax return to make it so that you don't automatically get audited, but you don't pay double tax, but we can flow all that income to your S Corp from a tax filing standpoint so that you get the benefit of the S Corp, even though your brokerage just didn't want to pay you under the S Corp name. So that is a possibility, but not all CPAs are created equal. We obviously know how to do that. And, you know, plug for us selfishly, we like saving people money in taxes, and this is what we do. So anyways, thank you everyone for your time. You know, Cari is integrated with Prime, and you'll probably be hearing from me again at some point. Oh, there she is.
I'm back. Yeah, absolutely. We're going to have you back. This is amazing. People are commenting. We had lots of great comments in the live stream. This is super, super helpful. I would highly recommend the call, and we really appreciate your time. We know you're busy, so thanks for being here with us today.
Yeah, thank you.
Thanks, everybody. Have a good day.
Thank you.
Thank you.